Welcome to the Profitable Farmer podcast, where we share stories and tips to help you run a better farming business and create your very own freedom farm. If you're looking to work smarter and not harder in your farm business, welcome. You're in the right place. G'day team, welcome again to Profitable Farmer. I feel like there is so much going on in the global economy at the moment, and I feel like perhaps the fundamentals haven't changed, but our reality as farmers have changed significantly as we roll into this season, perhaps characterised by inflation, no doubt, but increasing interest rates, perhaps softening commodity prices, and certainly respectful that for many in northern New South Wales and in other areas, we're coming into dry seasons. So quickly we move from a low interest rate, low inflation environment to one that is very different from that. And I think that has us asking different questions and really looking intently as business owners at a new reality and a new environment. And so with all that, I thought it perfect timing to ask our investment expert and off-farm wealth creation specialist, Terry Tran, to come back and give us his, current insight on what's actually going on around the world, looking into perhaps what's happening in our major trading nations and helping us cut through all the BS perhaps that we see in the media and get a really good, solid understanding of what's actually going on out there. Terry, it's always wonderful to have you part of Profitable Farmer. And looking forward for you to actually help us understand what's really happening at the moment. How are you?
Very well, thank you, Jeremy. And always a pleasure to be here as well and share the message of what's really going on around the world.
Yeah, it's great to have you again, Terry. Now, I understand you're just back from a Hervey Bay holiday. We talked in our last podcast about the importance of creating wealth so that we can tick off bucket list items.
Yeah.
Tell us about whale watching at Hervey Bay, Terry.
Yeah, definitely. If you've never done one, it's to add that onto the bucket list, because I've always wanted to obviously whale watch, but because I live in Sydney, but a lot of the whale watch cruises down here and even along our coast, it's all quite far away. When you go on a cruise for a couple $100 and they say, oh, there's a whale, and it's usually a half a kilometer away and you got to use your binoculars to see them type thing. But then this one, I didn't really have any expectations, like, okay, this is another one of those potentially. But Hervey Bay is the sort of the whale capital of Australia, I reckon, because they come into that area to actually breed while they're on their way to Antarctica, apparently. So they do hang around for a number of months to breed, teach the young of what to do. And we were lucky enough to get on a catamaran and spend the day out in the sea, not expecting too much, but literally a family pod came by our catamaran. We switched off the engines, of course. And then the baby calf actually hung around for about an hour and just circling our boat, going under our boat, and over time just building trust. So as long as we remain quiet, don't get too excited, it built trust enough that they were back floating and just showing off the belly. So, and that showed that they trusted us. And of course, breathing and blowing a mist that gave us a lot of whale spray along the way as well. And then about an hour later, it actually left, and we thought that, it's going, but ended up calling the parents back to actually have fun with it as well. And then we ended up having now 3 whales circling our boat for literally the entire afternoon. So that was an amazing experience, just seeing them that close on the boat. And literally we could technically get in the water if we could, not allowed to, of course, on that boat. But then the next day I did do another whale. This time was actually whale swimming. So going into the water, staying quiet, knowing where the whales are, and then letting them come to us. And lucky enough, another one, actually 2, came by and literally swum past us. And it was literally between 2 and 3 meters away from us. So it was almost like a mini submarine coming past us. So that big, I think they were 40-ton beasts, so they're not small. But very good fun.
Aren't they amazing animals? And what a memorable experience to get so close to them.
Oh, definitely. And you can see how calm and collected they are as well, which I think as humans, we should be as well, especially while we're running our businesses and also investing, and just being almost like a whale, just taking the time that you need and doing what you actually naturally, do, literally.
Yeah, it's a good point, Terry, that that we can learn a lot from these animals, perhaps around their composure and their presence, and just how to go about navigating their realities and our realities.
Yes,
So,
definitely.
well done on another bucket list item achieved. It's brilliant.
No, thank you. And I definitely highly recommend anyone who has never done it to put on their bucket list and go for that experience as well. And it's literally in our backyard, so it's not that far off as well. Because I do understand quite a lot of farmers are also from Queensland, so it is in your backyard. Experience it.
Absolutely. So Terry, shifting our attention to the things that have changed in our economy, perhaps since we last spoke. What's your read on what's happening for Australian farmers, but around the world, and specifically with attention to those major trading partners?
There's definitely key issues that I'm seeing, because in the end, as you know, Jeremy, there's a number of what I call recessionary type indicators that we are always watching on a quarterly basis. And those indicators at the moment, this point in time, every quarter, I'm monitoring those indicators for our major trading partners. So, because in the end, there are really three global areas or countries that control what happens around the world. One of them, of course, is Europe. The other one is United States, of course. And then the other one is one of our major trading partners, China, as well. So whatever happens in these three economies does affect the entire world, and we follow through. And primarily also whatever happens in the United States, i.e. inflation, interest rates, we always follow suit. We are always lagging behind them, usually by about a quarter. So whatever it happens over there. So recently, in actual fact, over the past week, the Fed has just increased their interest rate again for the 11th time. And now it's surprisingly, which I can't believe, it's been 22 years since the rate is at these type of levels. So they raised it again to their rate at 5.5%, the 11th consecutive one. And our RBA always, over time, will also increase our rates at the same time to sort of catch up or go towards them. And all the other central banks around the world, Europe, etc., will also do the same thing. The main reason being is that we have to follow, simply because if we don't follow, interest rates always drags money across to their economies. So if the economies or the other trading partners don't also increase their interest rates, for example, the Aussie dollar will drop. So the US dollar, which has been quite strong of late, and immediately once the Fed increased their interest rates, our Aussie dollar dropped against the US as well. So we never want that. We always want to have a good currency rate, but not too much of a massive gap or difference. So we always follow suit to ensure that there's always this balance as well. So in terms of taming inflation, I see that they have it has done its thing. And I mean, what a journey it's been in like less than 18 months, where it's gone from literally almost 0% to now 5.5%. And that's just the central bank rates. But of course, the banks need to make money, so they add their margin on top. And hence why a lot of farmers and even the individuals who have a lot of debt, they are probably struggling. And you can see mortgage stress or debt-related stress that is occurring right now. And we're definitely not done in terms of interest rate rises.
So what's your read on the US economy? That's obviously got to have a fairly significant impact on households and on their economy. What's your read on how they're going to navigate their next few years?
Yeah, the US economy surprisingly has been quite strong, and it's really shown by the share market as well. But it is important that one doesn't just look at the share market and go, oh, wow, it's great because the share market's going well, everything else is going well. There are certain pockets that have done very well, and what they have done is drag the entire, what they call the stock market index up. But the other industries or sectors haven't actually done that well. When you look at it individually. So the US economy at the moment is actually struggling as well. The only thing that is, I think, as the saving grace, not only in the United States, but also in Australia, is our unemployment rate, which is still remaining quite low. I think it's because of post-COVID, and that's still flowing through without the the amount of slowdown of immigration, etc. Plus, not as many backpackers coming into the country. So, in terms of people, a lot of businesses wanting to find find employees, they are not getting them. So they're taking whoever that is available. So our unemployment is still quite low at this point in time. Hence why at least people have jobs. But given enough time, as interest rates start go even further to tame down inflation further, because our inflation has actually, funny enough, in Australia, our inflation rate in the last quarter, as it stands right now, it's still 6%. US has done their thing because they've really racked up their interest rates to 5.5%, central bank rate at 5.5%, and their inflation was at a quarter ago was 9%, has actually dropped down to 3% in literally one quarter. So it's dropped down quite a lot. Whereas Australia, we've been quite reluctant to increase our interest rate too fast, which in a way it's the right thing to do because you would create mortgage stress. But our inflation rate is still at 6%, so still double to triple what our RBA really wants, because we generally, the central banks want that 2 or 3%, and by slowly and over time increasing interest rates, what happens is you'll find that a lot of businesses will then, who do have a lot of debt, and I do understand some of the farmers do have quite a fair bit of debt still, for the land, machinery, etc. Businesses end up struggling, with the ones with too much debt end up struggling, and what do? They of course start having to cut costs, and therefore one of the costs is also employees, and therefore eventually unemployment rates will also slowly increase as well. So everything has its flow-on effect, no matter what what we talk about. So at the moment, it looks okay on the surface, but given enough time, another quarter or two, things will eventually struggle in the United States, and especially even Europe. If you look at the which we can talk about, the 6 factors that potentially create recessions, Europe literally is failing on 5 of them. And from just seeing that, it literally is showing that Europe is slowly going to put potentially a mild recession quite soon. And of course, Europe being one of the major trading partners around the world, they will drag down the rest as well over time. So
just before we get to Europe, Terry, I understand Fitch has downgraded the US credit rating from AAA to AA.
Yes.
2 questions. Is that a concern? And has the USA learned from the GFC? And is their fiscal policy stronger now than it was going into a potential recession?
So in terms of Fitch, I'll answer in a couple of ways. In terms of Fitch downgrading from AAA to a AA+, 1 notch, it's not too bad, because Fitch is just one of the 3 global major rating agencies. There's the other one, which is Moody's and S&P, or Standard & Poor's. The last time that a ratings agency, Standard & Poor's, downgraded the United States was back in 2011, and that was over a decade ago. And because that was the very first time that it happened, there was panic and mayhem in the financial markets across the globe, and everything has just dropped by 10 to 15% overnight, literally. This time, Fitch done their downgrade, and it hasn't affected as much because I think investors have seen in the past what had happened, and then they generally want to take advantage of those, and which I did back then too. I saw that, and I took advantage back then over a decade ago. What may be the straw that may break the back of the camel is if Fitch does it once, that's fine. But if, let's say, Moody's and S&P also follow along, at the moment, they haven't done too much. They've just left it as is. But if they also see problems and they also do their thing and downgrade it as well, now all 3 of the global rating agencies do it, then that will definitely create a bit of mayhem in the financial markets, and they'll drag everything down as well. So at this point in time, it's still okay. Not much to talk about, really. And really, the reason why they did that is because of the dysfunction of the United States, really. When you look at our own political system, yes, we sort of don't agree with each other, Labor and Liberal, but we're nowhere near as bad as the United States, where they have this so-called debt ceiling that, because the United States, obviously, to grow their economy, they are the central, in a way, the central global currency. They are borrowing quite a fair bit of money from the world to fund whatever they're doing, infrastructure, etc. And whenever they bicker over what they call the debt ceiling, sort of a layer, and go, okay, we're now reaching our almost, it's an anomaly I'd like to use is almost like a credit card limit. So every single quarter they come together and they go, okay, we need to increase our credit card limit. And they get so close at this point in time that credit card limit is potentially getting breached. and then they have to come together to agree what's the next credit card limit that we want to get to again to borrow more money to continue funding our growth. And generally, a sane government should go, yep, do it way before it gets too close. But what the United States always does is push it to literally the last day where it gets literally that close that they cannot pay government workers. And the last time it happened was in 2011 when they couldn't decide, they disagreed, and the entire government departments all shut down. So people walked out of work because they were not going to get paid the next day, which was ridiculous. And I think they have learned from the lesson from that scenario. Hence why when they got close to it in June, I wasn't too concerned because there's no government close to election that wants to do that and be blamed for it again, like they had in 2011. So they, of course, last minute, they increased the credit card limit again and everything was okay. But in another quarter, they're going to have the same problem. So every single quarter is having the same thing. Hence why Fitch is saying, enough is enough. This is quite ridiculous. We just got to decrease our ratings for United States because we just don't think this is the right thing for a country of that size to keep on going. And now going to the GFC, Jeremy, in regards to, have they learned from the lesson? Yes, they have. And you could clearly see that in coronavirus. When the global economy shut down, I can't believe it's almost 3 years ago now, is that when coronavirus happened, we could see everything shutting down and not only the financial markets, but everything just plummeted. And the US government, if they did not, why I say that they learned from the lesson from GFC is that if they did not do what they did and step up to the plate and create all these stimulus packages, and then that rolled over to the world where all the other central banks, including RBA Australia, we saw the same thing. So we also released these stimulus packages as well. If that did not happen, then would have been a GFC number 2. So they definitely did learn from the past lessons of 15 years ago of the GFC. And then that lifted the markets, lifted confidence, and everybody was okay again, so to speak. Yeah, so yes, they have learned.
Good to hear. Thanks, Terry. So turning our attention now to Europe, you say they're in a tough spot and looking toward a real return to recession. Would you mind just giving us your view of that economy through the 6 key recession indicators that you mentioned?
Sure. So, Jeremy, if we recall basically the 6 indicators, I'll just quickly run through them so at least everybody understands what they are first. So these, despite what you hear in the news, there's always an economist that has their view. They can be right, they can be wrong, but generally I always find that they're actually more wrong than right. So it's actually far better to understand what are the indicators and what are the criteria, so we as individuals can see on a quarterly basis what determines a recession or a financial market crisis. And it always happens, year after year, recession after recession. These are the ones, and these are the criteria that seems to happen just from research. So the first one being interest rates. Whenever interest rates are, and I'm talking about the central bank rates, which of course our Aussie banks, US banks, they add at a margin to make their money as well. So when central bank rates are above 5%, then that's one particular factor. Inflationary levels need to be below 3%. And if they're above 3%, then that's another factor. The other thing too is corporate profit levels, because in the end, it's businesses that drive the economy. Without businesses, the economy fails because no one will have jobs. We want to see that these corporates and small businesses, they continually make money and they don't have flat or declining profit levels. So when we see that, that's an indicator as well. Then the fourth one, unemployment levels. At the moment, it seems to be okay because people are still looking for jobs, but unemployment levels, anything above 5% is a bad sign. Because if people don't have work, they can't spend. And then, of course, corporates and businesses start having to cut costs and also cut employees. So that's number 4. Then number 5 is overall GDP growth of the world, but also individually the countries themselves. So that needs to also be growing. So if it's flat or falling, also another indicator. That's the 5th one. And the final one, number 6, is what they call the PMI, or Purchasing Managers Index. That's broken up into 2 things, a services index and manufacturing index. So what that really measures is, are services companies still being able to make money, produce the goods, and manufacturing, of course, being able to make money and produce the goods. So there's a PMI composite reading as well. which combines both of those readings together, and that reading needs to be over 50. So these are literally the 6 major key components and the criteria. And why I say Europe is falling into crisis is because the only one that it's passing at the moment is interest rates, because if you recall, I said anything above 5%, the central bank at this stands is sitting on 4.25% interest rates. So it's definitely almost a percentage and a half lower than the United States. So that's the only key thing that's lower than that. But the issue, though, is I can't see that sustaining itself, because the inflationary levels in Europe, it's still sitting at 5.3, way above the 3% mark. And in order to tame that, what does one need to do, or central banks need to do? They need to increase interest rates to tame down the inflation and cut back confidence in terms of spending. So interest rates eventually is going to have to go up as well. Corporate profit levels are definitely declining across Europe. Unemployment levels above 5, they are sitting at 6.4% at the moment. So another break, from the criteria. Then GDP growth in the European nations across the board, they're sitting at this point growing at 0.3%. And the forecast is it's going to stay flat for the entire year. So that's another indicator. And then finally, the PMI composite, we need it to be over 50. It's sitting at 48.9. So out of the 6, 5 have failed. And the only one saving grace just looks like is interest rates, but I can't see that sustaining at 4.25 because of inflation anyway. So it's eventual that they'll probably increase, and therefore it'll fail on all 6 parts.
What's your read on how Europe might perform over the next 2 or 3 years? You mentioned recession. Do you think it's a long-term thing as sort of that combination of nations recovers from COVID?
Yeah, I think Europe is part of the issue with Europe as well is, as we know, the Russian-Ukraine war has been dragging on. So that's one of the other reasons why their numbers are looking so bad as well, because the confidence level within Europe itself is also declining because of that prolonged Russian-Ukraine war as well. So that's one of the reasons why, compared to, say, United States and Australia and China, that Europe is definitely, out of all of them, more of a basket case. Some people are saying that it's fine, things are looking rosy. It's definitely not. From last quarter, it's actually gone worse for sure. That's just from looking at the data. And I just see this as, I don't know whether it's going to be a prolonged major recession. I think it may be a mild one, but it's definitely going to be happening. I would say within the next, say, by the end of the year, something's going to break eventually. And how long it goes, who knows? I definitely don't have a crystal ball. We just look at the data on a consistent basis. But I would say that a mild recession there's a much more higher probability that a mild recession will definitely happen. And when that happens in Europe, that slowly drags down the world, because Europe is also a major trading partner of China. And if they don't buy from China, China will also suffer, which China, by the way, is also suffering at this point in time as well right now. Despite it being the growth engine of the world for the past 3 decades now, it is no longer the case. We thought that post-COVID, China will be up and running again because they had so many lockdowns, it wasn't funny. But the issue with China as well is that, which a lot of people don't know, is that in the past, they relied on foreign capital because of everybody wants that, began to serve over 1 billion people in one place, and had way cheaper labor, very smart labor as well, because of the way their universities were run. And a lot of the big companies like the Apples of the world all went into China to produce things because cheaper labor, smart people, everything's all in one spot. Plus, at the same time, after they produce it, they've got also a massive population size to also serve, to increase their profit as well. But as we know, with all these tensions with US and China, now with all the bickering between the two countries as well, political reasons for sure, the Chinese economy is suffering because, going back to the point where major corporations are no longer investing into China. So capital inflows are not going into China, which means that, what does that mean? It means that the companies themselves aren't able to access cheaper capital from America, so they can't grow. And primarily because I think it's just foreign companies being scared of a communist country, how things can just flip like a switch, which they did, because a lot of the Chinese companies, they were doing very well. Foreign companies were doing very well within the country, but all of a sudden, with one decision from central government, no of course, no debate required in China. Comes from the one man. Whatever he decides goes, being a communist country. And all of a sudden, by doing so, a lot of the foreign companies are now scared of investing more capital. In actual fact, they're actually withdrawing from China and trying to find other places to go to manufacture their goods. So they're diversifying the key risk because of the other issue of, China, Taiwan. 2027 is sort of the deadline, potentially a hard invasion like Ukraine. Fingers crossed it doesn't happen because that would be a disaster, how I see things. And they're slowly diversifying away from China into the countries like India and Vietnam. So, and it's easy to see. Whenever you buy something these days, even my Samsung phone, I just can't believe. When I flip over the back, in the past, it used to be made in China. Now, even my Nike shoes, made in Vietnam. Unbelievable. In a short amount of time, they've gone from literally China over to Vietnam and my own home country, which I went away from all those years ago. And these two countries I see as the major next, I guess, destinations for investment opportunities. And if one doesn't understand the companies themselves, which I would say, it is risky to go into those countries and try to buy those companies because we're not aware of what companies are actually great. Yes, they have numbers that we look at, like the Australian companies, but one would probably do better by just buying, I guess, index funds of those countries and treat it more, forget about trading, treat it more like a longer term investment and just opportunistically buy into those countries through funds, index funds, literally low cost index funds. Yeah. So, so I hope that makes sense, Jeremy, in a long-winded way.
Not at all. Great insights. Thanks, Terry. So how does China stack up against those same recession risk ratings?
Yeah, no, China is definitely having a problem. So if I look at Chinese figures, and in terms of in a way, sometimes Chinese figures I don't trust as well because they tend to, and hence why I don't invest directly into Chinese companies. I would rather have them, if they have dual listed, I'll buy the Chinese stocks through the United States because at least those companies have proper audited financial statements. But with the Chinese economy, it's sometimes hard to tell because what is real and what is fake, it's just not as open. But in terms of those criteria, the thing with China, like Europe, interest rates are sitting at 3.5% as it stands. The reason being is they're not increasing it simply because the inflation levels, unlike the rest of the globe, because of COVID lockdowns that they've had extended periods, their inflation actually is sitting at 0%. So they have had no inflation versus the Western world at all because of the closure of the economy for a number of years since COVID. So what that means is that their corporate profit levels, of course, that means that if it's dropped, they can't increase their prices. Unemployment levels is definitely gone a little bit ballistic. It's gone now above 5%. It's at 5.2. Whether it's actually 5.2, I don't know. I think it's actually going to be, I believe the true figure is probably a lot higher than that because there's a number that's come out with their the young people aged between 16 to 24. The amount of, they've got, almost 1.5 billion people. And the amount of graduates come out from higher studies, university studies, pretty much, 21% can't find work. So you can imagine 1 in 5 with even master's degree can't find work. And I watched a video recently and they are literally, and it was an insightful video because it showed them being interviewed and they were saying that the cost of living, their apartments, which used to be very cheap in the major cities like Beijing and Shanghai, they cost, I think the average, obviously their salary is lower than Australia, but the average number of years to buy a simple 1-bedroom apartment is 83 years to pay it off. 83 years. That's ridiculous. We have 25, 30-year loans. They've got 83 years to pay it off. So it just shows how struggling their young are at the moment. And people with master's degree, they were actually interviewed and they were doing cleaning jobs, Jeremy. They were cleaners after a master's degree in IT and banking and finance. And also doing, basically, they don't have Uber Eats, but they're doing the Chinese version. They're literally delivering food and delivering customers who using their cars, rented cars too, by the way, because I can't afford one, to actually deliver customers as well. People who need acting as taxi drivers literally as well. So I can just see that failing there too. And then in terms of GDP, they're definitely flatlining. And so the Chinese economy is definitely struggling. And hence why commodity prices are probably going to struggle over the coming period as well.
Yeah, we're certainly seeing a softening of some key commodities in Australia. What's your read on that outlook for America or the Americas, for Europe and China? What does that mean for, what are your headlines, if you like, for this quarter for us, Terry, given that outlook?
Yeah, I think the overall outlook is definitely being more cautious. It's not the time to expand. So if you were thinking about expansion over the next coming year, I'd say a year, probably pull back a little bit. And in terms of, I think it's, in a way, I see it the flip side, the opportunity to. So if you're looking at potentially expanding, I actually think that if you were looking at saying buying, next door neighbor and another farm, hold back, because you'll probably get cheaper prices. Interest rates will rise again. And whenever that rises, it acts as a gravity to so-called riskier assets, which is regarded as property and stocks. Of course, as stocks, we try to reduce risk as much as we can by our criteria, but technically, as a overall, stocks and property are regarded as much riskier assets than, say, cash in the bank or US treasuries or term deposits, for example. So expansion-wise, hold back, you'll get definitely cheaper prices. And the opportunity is, if you are patient enough, you'll be surprised at the level of negotiation you can have down the track in 6 to 12 months versus even now. And I'm already seeing quite a number of my friends are in real estate, and I talk to them, and they say, it's definitely slowing down, because when they used to have open houses, they used to at least have 10 people coming through minimum. Now they're lucky to have one. That's a difference. So the interest rates are biting, because the buyers themselves, either if they've got big loans, especially I think the millennials, who always thought, they've been born in a period where they thought interest rates at 2 or 3% is normal. That is not normal. I used to work in the bank, and they were, when I was a banker, they were 7 to 8% per annum. Even now, it's still quite cheap. It's normal now. And going back to my mum, I remember when she bought her house back in the 80s, it was at 17 to 18%. So our rates are not normal at 2 or 3%. So these guys who have bought, borrowed $1 million plus to buy their dream apartment or dream home, they are struggling. And then the ones who are now wanting to buy something like that, they can't go to a bank and they can't afford it, because the bank's criteria is actually also increased because of the affordability criteria as well. So yeah.
Those other metrics that you mentioned, corporate profit levels and unemployment levels and GDP growth, would you mind speaking to those for Australia?
Sure. So in terms of Australia, I'm just pulled up the figures for Australia. So let's quickly run through the figures for Australia. Interest rates are at above, obviously criteria above 5. It's sitting at 4.1 RBA. I don't think that's sustainable. That's going to rise simply because our inflation rate is still sitting at 6%. So it's double to triple what we want. Our RBA always wants 2 to 3%. It's sitting at 6 at this point in time. Their forecast is that it's going to drop. I believe, yes, it is going to drop, but it's still not going to, their 1 year forecast is still going to be at 4. They've said 4.1%. Which I don't think, 1 year is too far to forecast anyway. They always get it wrong. But we are still double at this point in time what we are. So that's definitely a failure there. Corporate profit levels currently across the country is sitting on 150 billion for the quarter. And their forecast for next quarter is going to drop by 10% down to 134 billion. And that's quite a significant drop for corporates and businesses. So that's another failure. So it's not even flat. It's definitely falling. Unemployment, like I said, the only saving grace at 3.5%, because a lot of service industries are still finding hard to get proper good employees at this point in time. And I see that. And hence why that's probably the only saving grace at this point in time. But then when corporate profits levels fall, I can't see that being sustainable, because their 1 year forecast in a year's time is going to be 4.8%. So it's going to rise from 3.5% to 4.8%, close to the 5% mark on unemployment. GDP growth flat at 0.2. And going next quarter to 1 year out, it's 0.1 and 0.3. So it's a very cautionary or another failure there too. And the big one, PMI composite, the purchasing managers index, we want it to be above 50. It's sitting at 48.8. So it's below that too. So that also fails. So Australia is actually failing on about 3 to 4 out of the 6 at this point in time.
So does that then suggest that a recession environment is something that we should expect into the near term?
I believe so. Yeah, I'd probably say there's a high, nothing is always a definite, but there's a much higher probability that I think Australia is quite, in terms of where we are, I think we are definitely the lucky country. Things are still okay, but going out 3 to 6 months, I think if Europe starts falling, US starts falling, we will get dragged down, and plus China, we will get dragged down behind it, because we are such a small economy on a global scale that whatever happens there ends up happening here, because if nothing, being also a commodity-driven country, if they don't buy our products, what happens to our economy? It of course slows down. And I think that's one of the key reasons why the corporate profit levels are dropping by 10% in just one quarter. It's because the countries like China are not buying our commodities as much, and hence why the price drop as well.
So insightful, Terry. Thank you. So what direction and guidance would you give to business owners and farm owners at this time, given what we've just described?
Yeah, so patience, of course, is the one thing, but I think the other thing too is to start preparing for a downturn. So if your business is not geared towards surviving in a declining market, we've had what I call a Goldilocks economy over the past few years with very low interest rates. That is not going to last, as you can clearly see from everything I've spoken about so far. So if we can somehow prepare the business and really review and create benchmarks, which I believe, Jeremy, you teach in Farm Owners Academy very well. So definitely looking at the benchmarking, your business, your farm, and ensuring that they pass the criteria that you've set, and then from there, then you'll have that peace of mind as well. And Jeremy, I actually would love to hear on your side the benchmarks that you run the farmers through.
Terry, I think the benchmarks that we apply to our clients' businesses are not dissimilar to those that you use to analyze the performance of the stocks that you invest in or recommend people invest in. Return on equity, return on assets managed, profitability, resilience, solvency, and then looking at all our cost ratios to make sure that we're not running business models that are too cost heavy. The frame, though, that I would put to that, and I think this is relevant in this conversation, is that we encourage people to set up business models on their farms that can break even in a decile 2 year. So, that's making a small loss or breaking even 2 years in 10, but a business model that in these times can be resilient enough that we know we can make a reasonable profit 8 years in 10. I think what we're seeing is a lot of farms, because of the optimism that has been out there, they've geared up, they've had a crack, they've made the most of these low interest rates environments. But there's that risk of having a business model that might break even in a decile 5 year, whereas in a decile 5 year, we've got to be making strong profits.
Yeah.
So and I think if we're heading into an environment that could look and smell a bit like a decile 2 or 3 year, I think there are some people that are feeling some alarm and concern because maybe their business models are not necessarily set up for that.
Yeah, and it's interesting that you mentioned the 2 year time frame, because Bill Gates from Microsoft, when he built his company, I always remember this, that he built the company on that same foundation where he actually said, I want to have enough cash in Microsoft. And this is when he was a startup back in the old days. And he had this mindset all the way to even to today, where they've got enough cash flow sitting there in the bank that will survive even if not one Microsoft product is sold around the planet, which of course is ridiculous. They'll sell products, but in that type of, very bad environment, that even if they don't sell one product, they will still survive that 2 year time frame. And funny enough, it sort of almost coincides with COVID, because that was sort of a 2 to 3 year time frame as well, a very desolate environment too. So that benchmarking and that type of criteria, if you can have that, it will give you the peace of mind. So yeah.
I think that's one that links beautifully back to that comment about our farm business models. I think there's risk and there's risky. And I think we need to be very careful having a risky approach to our next few years, given what you're describing. I think we've got to take a patient and a cautious approach. And to your point, maybe slow down how bullish we're being about expansionary steps and those sorts of things. It's great insight. And I think what's amazing about what you've shared today is there's a lot of hype and emotion around what's actually happening. To be able to look at Australia and our other major trading nations through those 6 key recession rating criteria that you have, just for me, I feel like there's a lot more control available when we look at our reality in that way.
No, definitely. And, you know, people get caught up with their pants down with a recession. Oh, it's happened. But recessions and market crashes, I always say, don't happen overnight. The data provided will clearly show you that something's wrong. And then it's far better to prepare for it and anticipate it. So when it happens, one, the business and the investments are prepared for it. In other words, having a lot of cash on hand, because then post-crash, we can then take advantage of those opportunities. You know, if you're expanding, you get far better prices, negotiation power. And even on the investing side, with all that cash, that's when you make the most returns, because you're cash heavy and ready to now reinvest, where people are now running scared because they got caught with their pants down. But whereas you're in that very fortunate position because you prepared for it and now taking advantage of the actual crash itself, which is awesome.
So what are the opportunities that you're seeing and that you are getting ready for from an investment standpoint, Terry?
Yeah, so we've been the same thing. We've been very cautious, like the farmers. We've been now more cautious just from looking at the data on our own investing itself. So we've been selling down, in fact, our own portfolio, sitting on about between 40 to 45% cash, which is quite high as well. And it's because I can foresee something is breaking, and therefore I want to make sure that I'm very liquid to take advantage of the opportunities coming along. And again, we avoided the hype of all the the AI, artificial intelligence, all those type of stocks that have been hyped up. So we've definitely avoided all those stocks which were way overvalued. And overnight, literally, it's just now that we're recording this, overnight those stocks have actually dropped quite substantially as well, literally overnight, because they were overpriced and they were bound to come down. It's just eventual. And then on the other hand, though, it doesn't mean that everything is, should be sold down and no longer investing. There are many what I call deep pockets of value where those sectors, industries have been shunned, i.e. the pharmaceutical sector, which is the likes of Pfizer, for example, which now post-COVID no one cares about for some reason. And those stocks have been sold down by 30%. So if you do a valuation on, say, even a stock like Pfizer, which everybody knows about, it's undervalued. So we want to buy these companies because they are very sustainable, very profit heavy as well. Plenty of free cash flow. They will survive tough times for sure. I mean, their profit margins are about 30%. So every dollar they take in, they make 30% profit. And then they're not just reliant on the one so-called COVID vaccine, so to speak. Of course, Pfizer's been around for a long time, unlike the likes of, say, Moderna, which was very COVID heavy. So we've always avoided those type of stocks. And Pfizer's got a library of different vaccines that supposedly fix other problems as well. So that's why we like stocks like that. And at the same time, I quickly looked at some of the stocks like the farming equipment, and I could see how in the short term how bullish a lot of farmers are, because those stocks have been driven up quite dramatically. The Deeres, the tractor supplies that produce the machinery that support the farmers, and their share prices have just been risen to new highs. It's because their profit levels over the past couple of years has risen because they're selling their products to farmers. And when you see that, I actually avoid those stocks. And I like those stocks, don't get me wrong, I want them, but I'm waiting for them to drop, and eventually they will. So opportunity-wise, at the moment, not very much. So that hence why we hold so much cash. But eventually those stocks that are overpriced will come back down. And all we are doing is taking nibbles at anything that has pretty much any bad news. So we actually love bad news. When that happens and a stock drops by 15, 20%, that's when we get interested and we buy undervalued stocks. So one, it reduces the risk because we're buying something of value. But two, the return is going to be higher, because when you buy something that's worth, you're paying, say, an asset's worth $1 million and you are paying either $1 million or below, say $500,000, and you've bought at the right price, eventually that will get back to where it should be valued at. And that's why the return will be far higher at lower risk as well. So yeah, so they're the opportunities I'm seeing. Not a lot at the moment, but deep pockets of different sectors that are showing up. And last week, for example, the advertising agencies. that we started to take a nibble at the global advertising agencies. They've been sold down by 15 to 20%. And obviously, due to recessionary fears, the market's expecting people not spending as much in advertising, and we like that. So I haven't invested in them for a while, but because it's now dropped 20%, I'm taking a small nibble to see how things go and start investing in those sectors as well.
As always, Terry, great advice and so insightful. So to everyone listening, a couple of times a year, Terry offers to run an exclusive investment masterclass for our community. And so our next one of those is on Wednesday, the 23rd of August. So just a few weeks away. And it starts at 7:20 p.m. Australian Eastern Standard Time. There's a link to that in the written intro to this podcast. And I highly recommend, especially given what we're learning from Terry already and hearing about what's playing out for us and in the global economy, as you set down your plans to create wealth off farm and perhaps leverage your farm balance sheets, that masterclass is a wonderful place to start. So get yourself booked in for that if investing is a priority for you and if you're looking now to strengthen your strategy for off-farm investing. Terry, thanks for putting that on again. There's always so much insight in that, and look forward to being online for that and to taking our community through that once again.
Yeah, no worries. And I always love running those events for your community as well.
So Terry, just in rounding out, Ted Lasso says to his team, be the goldfish, which I think means forget about the game last week. Let's focus on what's in front of us. I think what you're saying is be the whale, be composed, be patient, be alert to, be observant. But, you've been swimming with whales over the last few weeks. Is that your advice for us, or what would be your final comment on how we should be playing in the investment landscape at the moment?
No, definitely. Running the business and the investment landscape, exactly the same, being patient and cautious, and hence why we observe what's happening every quarter, these numbers and the criteria. So therefore we're prepared, and we don't want to get, be caught with our pants down. So definitely be the whale and observe, because I even remember the whale, flipping on his side and literally watching. I could see the eyeball watching us on the boat. And then he got comfortable and then, began to trust the environment. So be the whale.
Perfect, Terry. Thank you so much for your time. Look forward to seeing you in a couple of weeks on our investment masterclass, and really appreciate the insights that you've shared. It just gives us so much confidence and control going into a different economic environment.
Now, very welcome, Jeremy, and always glad to be here and share what I know to your community, and helping all the farmers get prepared of what's actually coming.
Thanks, Terry. Take care, mate. Bye for now.
Thank you. Bye.
Thanks for listening to another episode of the Profitable Farmer podcast by Farm Owners Academy. If you're new to this show, be sure to follow us. If you've been a long-time listener, let your friends know about us, or come continue the conversation in the Profitable Farmer Facebook group. All the best as you grow your business and create your freedom farm. Until next time, keep being incredible.